everybody, and welcome to the Dash Trader Newsroom. And this time we're going to be talking about the economic impact of the war in Russia and Ukraine and the sanctions that we've put on Russia and how they affect the market overall. We've certainly seen the roller coaster in the last 2 weeks since our last broadcast. As always, my name is Michael DeJoy. I'm the Director of Educational Services at Dash Trader, and I'm a licensed professional, and I'm joined by my co-host, Jill Molandrino, Global Markets Reporter at NASDAQ. Jill, how are you today?
Good, doing well. Thanks for having me, as always.
As always. I mean, you know, we kind of got the very beginning of the invasion of Ukraine, like the day after we had our last show, right as everything kind of just started. And obviously a lot has happened since, but before we get into that, I'd like to talk a little bit about the spring trading competition. The registration is now open. It runs from April 3rd all the way until April 29th. That's a total of 19 trading days. So the sooner you sign up, the more time you have for the boot camp. And what that does is it allows you to utilize the Dash Trader Simulator. And you can practice your trading techniques and your trading strategies and kind of get familiar with the platform. Also, some of the trading techniques that you might be using, see which ones are working best for you. As always, our prizes include 9 months of access to the Dash Trader platform. The winner's name up in lights brought to us by the NASDAQ. Thank you so much, Jill, by having the winner broadcast up there on the NASDAQ market site right in the middle of Times Square. And if you are interested in joining the competition, you can do so by visiting onebesttrader.com to learn more. And it'll be another exciting trading competition yet again. This is our novice spring trading competition. So let's just jump right in. 2 weeks ago, Jill, the war had just kind of started. The invasion of Ukraine had just started. And as a result, you know, we really just kind of were reacting to the sanctions and whatnot, and the sanctions really turned out not to be very severe. However, they did increase the sanctions. Really, I mean, I guess it was this week was when Biden came out and cut the U.S. from purchasing the oil from Russia, and certainly it was the week before that, right after we actually did the broadcast, that they took Russia, or at least some Russian banks, and froze Russian assets and took Russia off the SWIFT system. So just give me your reaction to the sanctions, the depth of the sanctions, and what the impact will be on the economy overall.
Yeah, well, of course, the obvious humanitarian toll is the first thing in front of our minds here. And as with anything, these sanctions that have been implemented are really going to impact the everyday people, right? We've seen it time and time again. And so, you know, I think when you look at it bigger picture, what will it mean for Russian business going forward when we hopefully come to the other side of this sooner than later? Who's necessarily going to want to do business with Russia, at least Western countries anyway? I had a trader on with me, just actually the interview before this, and we were talking about how the near-term pain could be a long-term gain for Western countries as we look to internalize oil and natural gas production, as well as the agricultural production, which will only longer-term hurt, you know, Russia and its allies. So it's going to be interesting, you know, not just in the next 6 months, year, 3 to 5 years, what globalization will look like going forward. I think it was a big lesson learned that perhaps there was hyper globalization, if you will, and we're feeling the impacts not only because of Russia and Ukraine, but certainly the pandemic supply chains as well, where we need to be a little bit more self-sufficient when it comes to manufacturing, ag, energy dependence. I think with the energy conversation got very convoluted when it came to us versus them, where they were expecting an immediate pivot to green energy and renewable energy resources, where it doesn't, you don't flip a switch and it happens overnight. So just like we talk about fintechs and legacy institutions, are we going to be talking about green energy and traditional energy companies and figure out a way how we can work together? Because clearly no one around the world is energy independent or focused or running, on all 8 cylinders with renewable energy. So it's going to be interesting to see how it plays out, and maybe the brakes needed to be put on for a moment. Other folks that I've spoken to, and I think this is really interesting, that ESG investments, and of course, when we think about environmental and sustainability, the two largest components of ESG, perhaps that narrative was put out there too fast and too furious. And while investors may have welcomed it, and perhaps many investors felt pressured to participate in ESG, the companies that are actually producing the products and so forth aren't able to make that quick pivot. Now, governance is one thing, the G part of ESG, where, it's a little bit easier to switch up the board structure and management structure than it is to right size the energy space in 1 to 2 to 3 years. And I think these sectors themselves and the investment industry itself is going to have to ask these critical questions. And I think the pendulum is starting to hopefully normalize one way or the other.
Okay, so just for all of our viewers out there, what does ESG stand for?
So ESG is environmental, sustainable, and governance. And a lot of investors are making their investment choices by voting with their pocketbooks, if you will. So when you talk about governance, do we have a significant mix of underrepresented minorities, whether it's women, LGBTQ, and other minority bases represented on the board? Is our management team environmental would be, switching from traditional drilling as an example, and harnessing wind and solar power. Sustainability kind of falls in the middle of those two, with investments that will do good for all, good for the environment, and it's something that is sustainable and has shelf life.
And then, of course, G was the governance part, which
the governance part. Yep.
Got it. So let's just talk a little bit about inflation. We had the CPI today, and certainly that gapped the market down. We have the highest inflation levels in 40 years. I mean, I would say price increased by 7.9%. I mean, this is getting pretty hyper as far as inflation goes. It doesn't seem like inflation's getting any better. And what brings to mind is at some point, inflation starts to cause stagnation of the economy. And I know this is a dirty word, but we're always ahead of the curve here. To me, I'm starting to get a feel like we're heading in the direction of stagflation. We are, especially now with, very little expected economic growth out of the Eurozone, and certainly less economic growth out of the United States with the impact of these sanctions. I mean, the U.S. economy is still growing and holding up better than everywhere else. But certainly the specter, I like to say the specter of stagflation, we had talked about this 2 years ago with the specter of inflation, almost two and a half years ago, we were ahead of the curve on that. And now I'm bringing up the specter of stagflation. What are your thoughts on the specter of stagflation and, of course, the possibility of hyperinflation?
Well, the possibility is very real right now. And of course, with this data, it's not something, again, that gets fixed in the immediate near term. I think these are going to be issues that we will be facing for quite some time. I think even without the Russia-Ukraine situation, the global central banks really did have a lot of work that they were going to have to put into to get inflation back under control, get supply chains back online. And it feels like almost, okay, we saw this in leading up to middle of December. It felt like things were getting back to normal. Then we get hit with Omicron. Get to the other side of that, feel like things are getting back to normal, scheduling travel, whether it's personal or business. I'm back on the road in April and hopefully not looking back. And then we have war breakout in Ukraine. So it's one thing on top of the other. And it's not just central banks that can raise rates and inflation is gone. It doesn't work like that. It's a number of things, and supply issues being one of them. And it's not just the cost of goods being sold, it's also the cost of labor. So there's just a lot happening right now. And I don't think it's something that will reside, certainly in the near term. It's going to take 2022 to come to some middle ground here. But, Mike, we are starting to hear some inklings of recession. Certainly we are late cycle here. But, if you think of it in very simple terms, the price of gas, anecdotally, my car, I have a small SUV, it's like 40, 45 to fill up. It was $70 on Sunday. Okay.
Absolutely.
And I have the benefit of working from home and access to mass transit. I don't have to make those choices of, oh my God, I can't fill my tank. Then you have the cost of food that has to go on the table, right? These are necessities you can't live without. Consumer discretionary, however, you can. Now, what's 70% of GDP? Consumer spend. So if you
Yeah.
see the dialing back of consumer spend, whether it's goods or services, then you have to start thinking about, okay, do we start saying the R word?
I mean, I'm going to go out there and I mean, from my perspective, I don't see that. I mean, people have been talking about the Fed and a soft landing. Now with the war in Ukraine, the Fed has gotten more dovish, not more hawkish, right? They've gotten more dovish. They've already ratcheted down the expectations for a 50 basis point hike in March to probably most likely a 25 basis point hike. To me, the possibility of a soft landing is becoming more and more of a pipe dream.
Right, agreed.
It's now looking to me like the only way that you can lead this economy out of this is to ratchet up interest rates, and that's going to cause a recession. I mean, if you go back to the Volcker, the lessons from I guess it was Paul Volcker in the 1980s. I mean, he ratcheted up interest rates into the 10-12% level, and that finally is what cooled inflation of the 1970s. In a lot of ways, we are having a redo of when I was born, and probably you were born. I didn't really experience it, okay, but I certainly heard the stories about the 1970s, and I did remember lines at the gas stations, and I do remember that was in the early 80s, and I do remember the recessions of the early 1980s. Of course, I was very young, and I was maybe 7 years old or something like that. But needless to say, this is kind of a replay of the 70s going into the 80s with war, stagflation, possible recession, high gas prices, high prices at the pump. So unfortunately for me, I'm going to say that my opinion is I don't see how the Fed can pull a magical soft landing. Certainly, in my opinion, the Fed waited way too long in a very dovish fashion. And
see, Mike, I will also say that perhaps the Fed also ran out of tools to help control the economy. We saw political pressure on the Fed, which was somewhat unprecedented. And under that pressure to keep cutting rates when the economy was fine at that point.
Yeah,
so
absolutely.
There are no more options, and we're starting to see with them dialing back. And again, of course, what's happening in Ukraine is a big part of this, but you know what it's like trading. How often do you see 2, 3, 4% moves in the major averages round tripping in the same day? There's no liquidity. There's no liquidity. So there's that too. And it's going to keep investors off the sidelines because, to be honest with you, certainly you and I, have been through this, but you have a very young generation of traders out there who have seen nothing but the market go up. This is scary.
13-year bull market, 13-year bull market, and pretty sustainable growth. This is a wild market, very reminiscent of the financial crisis, and more so reminiscent of the dot-com bubble and bust. So, which you and I have experienced, but most people have not. More sanctions on Russia. Now, to me, this is the other thing too. I'm a little bit skeptical about sanctions because number one, China's not participating. So China is going to stand to benefit. So Visa, MasterCard cuts Russia out of its service loop, and of course you have Union Pay, which is now the up and coming new credit card process. So Russia switched to Union Pay. You have India, who certainly did not call the invasion an invasion. They call this a spat between Russia and NATO. You have Brazil not participating, pretty much, saying that, look, this is their problem. They'll figure it out. We're not saying anything. We'll sit on the sidelines. We buy fertilizer from Russia. So, basically you have the breadbasket of Europe, which is Russia and the Ukraine. You have Russia and Belarus as two of the largest producers of fertilizer in the world. Russia, the largest producer of nickel in the world. So you can't say we're going to be creating EV cars out of this and that we won't be driving, gasoline powered cars, because you can't have an EV car without nickel. So you have grain impact, you have corn impact, you have pretty much every agricultural product in the world impact, because besides for Canada, maybe a little bit of the United States and Morocco and a few other places around the world, Russia and Belarus are the largest peat and fertilizer producers in the world. And every crop needs fertilizer, unless we source it some other way, like you said, which is not a short-term solution. So at the very least, I mean, we have the real possibility of a food crisis. And obviously with inflation, there's a lot of people bordering on the realm of just really not being able to make ends meet and not being able to pay their bills. This is a real problem, not so much right now, but in 2 to 3 months, I think that we're going to have a whole mess of greater problems due to this interruption of the food supply.
Right.
What are your thoughts about this, the craziness, the commodity breakout and snapback, and the long-term effects of the war?
You know, it's really interesting, and I didn't really put 2 and 2 together until listening to you speak, and of course, in agreement with everything. But you know, many people are anti-GMO, genetically modified products.
Not Europe anymore. They
well,
just said,
here's the whole
okay,
thing.
we're doing GMOs.
Look, Mike, it is very easy to put out organic ideals, if you will. I want to be respectful of, you know, everyone's feelings on here. But when you have to make a choice between having food on the table and the supply chain, I think those feelings might subside. I read an interesting thing on Twitter, and again, it's Twitter, take it for what it's worth. But somebody had made a point where, you know, it's very easy to have ideal principles when everything is good and
Perfect, yeah.
you know, it's, you know, a lot of these things on paper sound good, and when things are going good, it's there's no pandemic, there's no major war, it's very easy to insert yourself in these organic conversations, if you will. And you know, like I said, there is a generation of people who have never had to kind of make these decisions. We also have to remember, we grew up in a place in the US, we can't identify, well, I shouldn't say we can identify, because there are certainly segments in the US that deal with food poverty. But we are all grew up in a democratic society. We can't fathom what it's like. It would be like New York invading New Jersey.
Yeah.
So it's hard for Americans to
I've thought about
really
that a few
understand the
times.
scope.
I have to tell you, I've thought about invading New Jersey a few times.
Right.
I'm just kidding.
So, you know, we're being faced with principles that we just have never had exposure to. So I'm curious to see what happens with the GMO market.
No doubt.
It might be kind of like an outlier, but
it really is it's worrisome, because I don't think that we really know the full effects and the full ramifications of the interconnectedness, especially of the agricultural market. You know, I mean, certainly in New York, we kind of, you know, I think about this all the time. We have a really privileged existence. We are kind of it's somewhat the financial capital of the world still. And certainly we get a perspective of everything's always readily available. You go to the stores are full. And I believe that in this situation, you know, we may see empty shelves and or ridiculously high prices, and all of those high ideals of not eating, you know, GMO foods and whatnot, eating organic, they may go out the window. I mean, because certainly we saw Europe already ratcheted out and cut out its anti-GMO policy. That was the first thing that it did. All right, well, let's talk a little bit about Amazon. And I mean, this is a big stock split. I think is it a 20-to-1 stock split? I mean, it's pretty hefty. It's a big stock split and a pretty significant stock buyback program. Now, to be honest with you, like, I know Amazon's business is a very, very low margin business, and it's very, very heavily impacted by inflation and costs. So, you know, I'm very interested to see how investors look at Amazon going forward. Certainly Amazon was a darling of the pandemic, because, you know, you were at home, you were stay-at-home orders, and everybody was at home. And now we have a whole different mess of problems. We have global supply chain interruptions, countries being sanctioned, and Amazon, to me, is doing a little bit of smoke and mirrors, finally splitting its stock and seeing if the retail investing public will buy it up, as well as buying back some of its stock to boot. What are your thoughts on this overall? I mean, this has been a pattern of this entire market rally during the pandemic.
yeah, well, you know what, it's interesting. we know what happens with buybacks. You and I have been through a couple of the larger companies, and we've spoken about this before. And this is kind of what makes it hard for my head to wrap around. It doesn't change the valuation of the stock. And I think that narrative, well, it'll be more attractive to retail investors, less capital intensive. Well, guess what? These things trade in slices now. So, you know, unless you're really that concerned about voting rights, which I would imagine not many people are thinking about, especially when it comes to Amazon, nothing has really changed. So fundamentally, we know that. But when you look at historical charts and what happens after these high flyers, like, you know, Google, Tesla split, the stocks do well.
Apple did very well.
Yeah. So I only think, honestly, that companies such as these big NASDAQ 100 names can perhaps get away with that, because there not only is there investor demand, but you have that retail demand, and these are stocks that people identify with. I'll be curious to see what actually happens with the share count, and what Amazon, you know, if it does announce future buybacks and so forth. I think that's really going to be the tell there. But again, I think investors, you know, like if you have a stock that's $100, you split it 10 for 1, $10 times, you know, we all know how that math works out. So I just think it's kind of buyer beware when A, slices are available, and B, valuation doesn't change.
To me, like I said, I think this is just somewhat of smoke and mirrors. The interesting thing to watch is how the retail investing public reacts to Amazon this time around. The market is a very different market than when Apple did its stock split. And certainly Twitter just did a stock buyback announcement, and Twitter stock has been in, you know, has not been doing so well. So certainly this is just you know, another one to watch. I think it's going to be a key indicator of the market going forward.
Yeah.
Well, thank you so much, Jill. I'm going to jump to the charts and do my regular review. I look forward to seeing you in 2 weeks.
All right. Sounds good. Have a great day, guys.
Take it easy. Take it easy. Bye-bye, Jill. As always, thank you. All right. So I'm going to jump to the charts, everybody. Let me just swap out my screen. Hopefully my charts don't crash from all the wild market activity. I'm just kidding. I'm using Dash Trader. That would never happen. But the market certainly has been wild. So this is the long-term chart on the SPY, and I'm going to bring up the MACD and we have some incredible tools inside of Dash Trader, like the MACD and the CCI. Let's just see which one I'm going to put on here, the RSI and MACD. Okay, so I got the RSI on here. So what we can see from the MACD here on the SPY 1-day daily, if you see, we've broken the predominant trend. So this was the big trend line. I'm going to draw a trend line on this. So we broke a very, very big, you know, long-term trend here. We came back, snapped back to it. We broke it again. We also broke horizontal support. I'm going to put horizontal support was right here. We broke it. This is the gap down on the war. We snapped back. We sold off again. This was just 2 days ago. And now we're just kind of consolidating in what looks like a bear pennant formation. And now the RSI is still kind of in the middle, and the MACD really could go either way. I mean, it's not saying up, it's not saying down. It certainly is leaning to the direction of down, but it's also at these kind of very, very oversold levels. So sometimes when it gets very oversold, it can snap back. Let's do this analysis on the QQQ real quick. Same kind of situation on the RSI, same kind of situation on the MACD, but with a little bit more in the bearish direction. Certainly the QQQ is more oversold than the SPY is. I'm just going to snap on a trend line. Here we go. So there was the break of the trend line. There was the trend line fade. Here's the secondary breakdown. And certainly we're kind of hovering around here. We're not far from our moving averages at this point because we've gone sideways for just about 2 to 3 days. So we've kind of caught back into the 10 and 20 period moving average on the QQQ. But all of the moving averages are down. We are down over 20%. I mean, we are in bear market territory. Any rallies or bounces should be considered bear market rallies or bounces. I mean, this is a pretty bearish market. The IWM, which tends to be a leading indicator. So this is the IWM. IWM consolidating sideways, not really breaking down yet. Certainly looks like a bear flag. RSI, the MACD has gotten more into the area where it is not so deeply oversold and may be ready to break down again. RSI is also at a key number, 200. 200 is a key breakdown point for the RSI. So when the RSI broke from 222, it went down to the 200 area, and it's kind of consolidated in that area ever since. So I'd keep an eye on the RSI, on the IWM, which is the Russell 2000, as an indicator for the breakdown in the rest of the markets and the broader markets. This is the Dow Jones. Dow Jones Industrial Average is not looking quite so as bearish as the NASDAQ Technology Index. It is very, very oversold on the MACD, and it is also very oversold on the RSI. So from the indicator perspective, you could expect some kind of a bounce or rally from here because things are so deeply oversold. DBA. This is a commodity ETF called the DBA. Tracks a bunch of key commodities, and look at it. I mean, just slam, bam, blast off. Massive blast off on all of the key agricultural commodities. Now, they did get very oversold, so wait for this to pull back before you join that trend. But probably this is a long-term uptrend in the commodities market. I mean, you could see the volume. So anybody who bought and collected a position back here, they were dumping and selling with glee up here at 22. That's a tremendous move from 17 to 22 on this really usually very sluggish commodity index. USL reflects oil. I mean, that was the big blast off in oil, and this was the big pullback in oil. But I would expect us to kind of, again, oil did kind of have some short-term solutions put into place. I would expect more upside to oil. A trend like this is a mega trend. It is overbought at this point, so it needs to kind of come back to reality. But certainly watch for this to pull back into its moving averages and then to come back to reality thereafter. Oil is another oil ETF, kind of same story. We had a huge run up on gold, and Jill and I have been talking about gold for a really long time. There's even some rumors that Russia is going to go back to the gold standard now that they've been kind of sanctioned by everybody. And the other one that's doing really well is silver. Silver had a tremendous run to the upside as well. So gold and silver certainly looking higher. I'm going to pop on the weekly chart because you can see the weekly on silver. So I mean, we still have a lot of upside on the weekly chart on silver. So we're not even near weekly highs. GLD kind of came in and kissed the all-time high or most recent high from the beginning of the pandemic on GLD. So certainly we are overbought, but when it waits for it to come back to reality, and I certainly think gold will pull back and then break out again. Certainly the fundamental reasons are there. And let's just see. So let's take a look at Amazon. We talked about Amazon today. Here's Amazon. This is on the weekly chart. Amazon making a strong move back to the upside. Certainly on the news. So the initial reaction to the split and the stock buyback program is good. Amazon is trading up. Let's see if those gains hold and see how the market reacts from here. So usually, like Jill had said, a lot of the big tech names do very well when they have these kind of stock split announcements. All right, so let's just jump back to our announcements and wrap it up for this week. Okay, so stay up to date with all things DAS by signing up to our monthly newsletter emails. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel, DAS Trader TV, and the DAS Newsroom for reminders. Certainly hit the little bell so you get an alert when we have a new session out. Follow us on all of our social media outlets, which is LinkedIn, Twitter, Facebook, and Instagram. Until next time, everybody, trade well, be cautious. The market is very, very wild and tumultuous out there. Looking forward to seeing you all soon. Bye-bye, everybody. Have a good weekend.